Hey everyone, Longacres Finance here, and today I will be taking a look at dividend growth stocks in the communications sector. This sector consists of companies that transmit data in words, voice, audio, or video across the globe. So we will be talking about telecoms, cable providers, book publishers, and the such. I have chosen to focus on 7 unique stocks that have at least a 10-year dividend growth history. The chosen stocks are AT&T, Verizon, Comcast, Activision Blizzard, Omnicom Group, Telephone and Data Systems, and John Wiley & Sons. I'm not recommending any of these stocks for purchase, but I do own 2 of them, Activision Blizzard and Comcast, in my personal portfolio. This video will be more illustrative to give you more information on each of these stocks if you happen to be looking into this sector currently. As you will see, some of these stocks are very good with solid growth histories, and some have performed very poorly and may not have a bright future. I'll start by taking a look at past performance and growth, and wrap up with a current view of each stock. Let's start with a little competition. Which of these 7 stocks do you think had the best total return since 2010? Here's a little race of the total growth of a $10,000 investment into each stock on January 1st, 2010, assuming all dividends were reinvested right back into the position. Let's start the individual stock review with our winner, Activision Blizzard. Activision is a game developer, but they happen to be classified as a communications stock. They are quite different from the other 6 stocks in this video. Whether you're into gaming or not, you may be familiar with Call of Duty, World of Warcraft, or perhaps Candy Crush. Those are some of the popular games from Activision Blizzard. Taking a look at the stock's total return versus the S&P, we can see that Activision has been a clear winner. The stock did have a major pullback at the end of 2018 and through 2019, but over the long term has really outperformed the broad market. Dividend income and reinvestment added about 75% to Activision's total return, which is a nice icing on the cake here. Revenue growth really took off around 2015, then flattened in 2018 and dipped in 2019, as reflected in the stock's total return. But we can see positive revenue growth resumed in 2020, fueled by the pandemic and probably more people stuck in their homes playing video games. The long-term PE ratio has oscillated between 10 and 40 during the past 10 years. You can ignore this blip as it's skewed data based on the drop in revenue we saw earlier and shouldn't be factored into the long-term PE ratio average. I would say at the current PE ratio of 33, Activision is probably fully valued, and perhaps slightly overvalued based on its long-term PE ratio. Let's jump over and take a look at the dividend scorecard. Activision has excellent grades for dividend safety, growth and consistency, but a pretty poor grade for yield. And rightfully so, the stock pays a very low yield of about 0.5%, and that yield has been trending down as the share price has experienced great appreciation. Looking at the stock's long-term dividend yield, it is currently at an absolute bottom. The yield on cost looks very nice. This is what a dividend growth investor likes to see. Had you purchased Activision 10 years ago with a 1.5% dividend yield, today your yield on cost would be 4.5%. Activision pays one annual dividend that is actually coming up in May, with an ex-dividend date on April 14th. They have a solid streak of dividend growth with a long-term growth rate in the low double digits. This growth should continue because they have a very low payout ratio with plenty of room for future increases. CFRA has a buy rating for the stock with a 12-month target price of $117, suggesting about 25% upside from the current share price. They also expect Activision to grow its earnings per share at a solid rate of 13% per year over the next 3 years. The second best stock in the race was Comcast. Everyone should be familiar with Comcast as they are a broadly known name in the TV and internet space, but maybe fewer people know that Comcast owns NBC, and therefore is a rival of Disney with NBC's Universal theme parks. Taking a look at the total return, we can see Comcast has almost doubled the S&P total return over the past 10 years. A little over 100% of this total return is attributed to the dividend income and reinvestment. Revenue growth has looked pretty solid for the stock during the past decade, but has flattened off in 2020. We can see the PE ratio is a lot less volatile as compared to Activision. The ratio has hovered between 12 and 26, with a little drop off in 2018. As you can see, Comcast is currently at the top end of its long-term PE ratio, and therefore may be trading above its fair value. Taking a look at Comcast's dividend scorecard, we can see solid grades for everything except the dividend yield. The current dividend yield of about 1.6% is one of the lowest historically for the stock. There have been opportunities in the past to pick up shares of Comcast with a dividend yield above 2%, and on occasion above 2.5%. This also suggests the stock is trading a bit hot right now. Comcast has an excellent yield on cost historical chart. Had you invested in the stock 10 years ago, picking up a 1.76% dividend yield, your yield on cost today would be about 8.5%. Comcast also has a nice streak of dividend growth, averaging about 13% per year over the last 5 years. Seeking Alpha has been having some issues with the dividend histories, so I had to compute this one myself using other sources. CFRA has a strong buy recommendation for the stock. However, the 12-month target price of $60 is pretty close to the current share price of the stock. They are projecting a solid 12% per year EPS growth rate for Comcast over the next 3 years. The third finisher in our race was Verizon, one of the largest telecoms in the US. Verizon's 10-year total return has come up short of the S&P 500 by about 120%. Much of this diversion came during the last 2 years, and about 90% of Verizon's total return is attributed to the dividend stream and reinvestment. Revenues grew for Verizon up to 2015 and have since flattened out at the current $130 billion level. The historical PE ratio has hovered between 10 and 20, with a bump in 2013 that shouldn't be factored in. Currently, Verizon trades for a PE ratio of about 13, suggesting the stock may be undervalued. However, the stock has trended at this level for a long time, which may imply this is a new fair value level for them. Looking at Verizon's dividend scorecard, we see nice grades everywhere except the growth section. Historically, the stock has offered a very generous dividend yield of about 4 to 5%, and currently it hovers right in the middle at 4.5%. The historical yield on cost looks decent for Verizon. Picking up the stock 10 years ago for a 4.5% dividend yield would give you about a 7.3% yield on cost today. Dividend growth has been pretty low here, hovering slightly above 2% per year on average, and I wouldn't expect this to change in the future. CFRA is recommending to sell the stock at the moment with a 12-month target price of $50. That is below the current share price. They are also forecasting rather low 3% per year EPS growth rate over the next 3 years. Number 4 in our race was Omnicom Group, who is a provider of advertising, marketing, and corporate communication services. In terms of total return, the stock has really underperformed the broad market during the past decade. The dividend stream and reinvestment would have doubled your return in the stock during the last 10 years. Revenue flattened around 2014, then started declining in 2019 with a strong downward acceleration last year. The stock has traded between an 8 and 20 PE ratio, and currently looks to be above its long-term average, nearing a PE ratio of 18. Seeking Alpha gives Omnicom a rather poor dividend score for safety and growth. They do offer a decent dividend yield, north of 3% right now, and the stock has a very long history of dividend growth. CFRA has a hold recommendation for the stock with a 12-month target price of $70. That is below the current share price. They are projecting a modest EPS growth rate of 7% over the next 3 years. Number 5 in the race was AT&T, the other large telecom in the United States. In terms of total return, AT&T has significantly underperformed the broad market, earning about 200% less over the last decade. Looking at the price versus total return, we can see that the dividend stream and reinvestment accounted for the bulk of the total return. Revenue for the company has gone up, which is always a good sign. Too bad it wasn't reflected in the share price. The PE ratio chart here looks pretty goofy, so I won't try to interpret what's going on here. AT&T is currently trading for a pretty low PE ratio of 10. AT&T also has pretty good dividend scores, except for growth. The dividend stream has grown at about 2% per year for the last decade, which isn't bad considering AT&T pays a very generous dividend yield. Looking at AT&T's historical dividend yield, we can see that right now, they are offering one of the most attractive yields compared to the last decade. Of course, the combination of a historically high yield and slow dividend growth must mean that the share price has declined. CFRA gives AT&T a hold recommendation right now with a price target of $35, which would imply they foresee some short-term price appreciation. The forecasted EPS growth rate is set at 3% for AT&T over the next 3 years, which is rather low, but in line with how the company has been growing. Number 6 in our race was John Wiley & Sons, that defines themselves as a research and learning company. I mainly know them through the overpriced college textbooks I bought from them. The stock has performed very poorly over the last decade, with a total return of only 31.5%. Looking at the price versus total return, we can see that reinvesting dividends multiplied your total return by about 10 times. Total revenues have remained flat, but oscillated throughout the decade. The PE ratio looks goofy again for this stock. Seeking alpha must be having some issues. From the summary page, we can see that the stock's forward PE ratio is 19 right now. I would say that is in line with the normal market average. The stock has a pretty poor looking dividend scorecard, with low scores for growth and yield, and a very bad looking safety score on top of that. John Wiley currently offers an average yield of 2.7% that looks slightly above its trailing long-term average. The yield on cost is pretty flat due to no share price appreciation. Dividend growth looked very strong through 2012, but has rapidly deteriorated and was only a mere 1.3% last year. CFRA did not issue a stock report for John Wiley, but does have a buy recommendation for the stock as of March 11th that comes with a moderate risk evaluation. And the last stock to finish was Telephone and Data Systems, which is a telecom, and I bet many of you have heard of them. They operate as US Cellular, which used to be more popular a few years ago. The company also offers other wireless and cable services throughout the United States. The stock has a negative total return during the last decade, which is just awful. If we look at the price return versus the total return, had you not reinvested the dividend income, your total return would have been about 20% lower. Revenue has remained rather flat, between 4.8 and 5.2 billion. The PE ratio looks scattered on a long-term basis, but has trended downwards to the low double-digit level currently. The dividend scorecard is average, with a low grade for growth and yield, but a very strong grade for consistency and a decent safety score. The stock currently offers a dividend yield of 3% that is pretty high compared to the stock's historical dividend yield. Yield on cost has trended downward, as is expected by the poor share price return. Dividend growth has been slowing down from 5% to 4% and now 3% per year. The stock does have a very long, 46 years of dividend growth history. That is a very nice achievement. CFRA has a hold recommendation for the stock with a price target of $22. That is in line with the current stock price, and there are no projected earnings figures. Now on to the second race. Since not all investors have a large chunk of money to throw in the market at one time and let it ride for 10 years or so, I thought it would be interesting to see how dollar cost averaging $100 per month into each of these stocks would shake out. Here's the same race as before, except now each position starts with $100, and I added an additional $100 each month. Who do you think will win this one? That's it. Thanks for watching.